Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to concentrate on Singapore dividend stock. So now probably most of us actually will predict that Fed will actually cut the interest rate. So with potential interest rate cut, okay, so which Singapore dividend stock should we invest in order to have the better use and also the growth? So basically this will be the objective of this video. Guys, if you're keen to know more about financial discussion, please see the playlist under the description. Over there, you will be able to find a series of discussion on financial discussion. Before I continue, guys, I'd like to urge you guys to help me by like this video. Just give me a few seconds. Press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe to this channel and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer. I am not a licensed financial advisor. The content in this video is for entertainment and education purpose only and should not be considered financial advice. In this video, I'm simply showing you what I may be doing. Please conduct your own independent research and consult a professional if needed before you commit to an investment. Never invest more than you are willing to lose, and always be sure to read the fine print and the terms and conditions before you commit to an investment. Okay, so with this, we are ready to kickstart today's discussion. Okay, so this is according to CME Group. Okay, so from here you can see that 98% actually think that Fed will actually cut the interest rate during the October 2025. So I must say that there is a very high chance that Fed probably will cut the interest rate. Okay, you can see very little amount of people actually think that the Fed rate, okay, the Fed will keep the rate unchanged. So therefore, with this principle behind, okay, so when Fed actually cut the interest rate, we probably need to recalibrate our investment into Singapore share for dividend. So therefore, this is the key objective of this video. This is what I have explained earlier on this year. Okay, so you can see that earlier on this year, in fact, you can see that almost 50% is actually on Singapore three biggest bank. At that time, probably we cannot see so-called the Fed actually cut the interest rate. So therefore, from that particular occasion, you can see that I actually mainly concentrate on Singapore Bank, almost 50% on Singapore Bank. And this is actually for REITs. Okay, so REITs only just 10%. And you can see from here, these are so-called the industry or infrastructure, and these two are actually the others. Okay, so basically this is how I suggest to buy the Singapore stock when the interest rate remain very, very high. Majority of you guys probably will benefit when you actually invest into the banks. Okay, so basically this is what I know. Okay, so from here you can see that majority of the banks, like this is actually for DBS, you can see that they are actually at all-time high now. Okay, same for OCBC, which are almost near to the all-time high. Same for UOB. Okay, so basically from here you can see that if you have invest onto bank, okay, so you probably can do some calibration, okay, onto your portfolio, okay, in order to enjoy a high yield dividend stock. Okay, so basically this is what I want to suggest later on. Okay, so this video here, okay, I actually do an explanation. Okay, I explained that what will happen to the REITs when actually Fed cut the interest rate. Okay, so basically when Fed actually cut the interest rate, majority of the investor will actually shift their portfolio into REITs. Okay, so this video I actually explain why. And since you invest into REITs, okay, so it is always very risky to select one or two REITs. So therefore, this video I also discuss what are the different types of REITs that you can actually invest in Singapore so as to spread out your risks. Next, this video, okay, I actually explain, okay, why it is still beneficial to invest into Singapore Bank. Okay, so although we know that probably Fed will cut the interest rate, okay, so why it is worthwhile, okay, to invest into Singapore Bank. So this video, I actually explain both the bull condition and also the bear condition when we actually invest into Singapore Bank when the period of Fed actually cut the interest rate. So if you're keen to see this video and that earlier on video, I actually will put the video link under the description. Okay, I don't want to so-called provide a link for this video. Okay, I don't want to distract this so-called viewing of this video. So therefore, all those relevant links I will put under the description. So if you keen, you can take a look and understand the whole situation. For example, this video I explain how can you actually reinvest into the different types of REITs in Singapore. This video I actually explain why it may be still good to invest into Singapore bank. Okay, so basically I discuss both the bull and also the bear condition. So this video, like I mentioned earlier on, I like to concentrate on the dividend stock in Singapore. Okay, so the dividend stock is not just bank and REITs. Okay, from here you can see that we have industry, utilities, telecoms, and fall under others also. So these are all the so-called possible stock that actually offer pretty good dividend. Okay, so before I continue, I must say this. I'm not suggesting you guys to invest into so-called stocks that in Singapore that have dividends. Okay, so if you have done your homework and if you decide that you actually want to invest into Singapore stock for dividend, so this is actually the video for you. This video, okay, I will explain okay, what are the possible choice that you can actually choose in order to diversify your risk on the stock for dividend. So I guess majority of us just mainly focus on bank and REITs. Like I mentioned earlier on, we always want to diversify our risk. So therefore, this video, I will show the other possible so-called choice of stock for you to invest for the dividend. Okay, so guys, before I come into deep detail, which stock to choose for your dividend, I need your help. Please help me to like this video. When more guys actually help to like this video will have a better chances to reach up to a larger audience. So guys, help me press the like button now. And if you have benefit from my earlier on video, and if you want to support me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. So now, okay, let me explain why I do DBS 15%, UOB 5%, and OCBC 10%. Okay, so basically this is how I relocate my stock, okay, in Singapore for dividend. Okay, so from here, as I mentioned that most likely Fed will cut the interest rate. This video, I'm going to explain why when Fed cut the interest rate, why I still go into Singapore bank. Okay, so invest in Singapore banks during Fed rate cuts is definitely justified. Okay, because majority, okay, in fact, this big three bank, okay, they are actually very resilient and they actually diversified and they are also well capitalized. Okay, so most of the time now, okay, the three big banks in Singapore is not make a profit just about the interest rate. In fact, their massive wealth management and fee-based business actually will thrive in a very volatile markets and definitely can offset the margin pressure. Okay, so definitely when the interest rate reduce, they definitely meet lesser market. But you can see from here, okay, they have other avenues. For example, their wealth management, okay, where they actually collect certain fee. This actually can buffer the interest rate, the reduce of interest rate profit. Strong defense, they have pristine loan books and huge capital buffer, making them safe and reliable dividends payer. Okay, so basically you can imagine this. Most of the time, Singapore bank, they are actually all very, very safe, especially these three big banks. And in order to remain their reputation of giving dividends, so I believe that they will still give relevant, good so-called dividends in order to keep shape their so-called reputation. So this is what it means by strong defense. Long-term growth, they are a direct play on the high growth Asia economics. We know that okay, even at a very bad time, this few year will be definitely Asia economic, which means that Asia economic will most likely will be boom. So therefore, they are actually in the direct play because they are the bank. They can provide a loan, etc., to those who initially start up, as you can see from here. So definitely with this kind of structural trend, they can actually outweigh the short-term interest rate cut. So in short, if you invest in a strong, diversified financial situation, not just a bet on interest rate. So this is why I still think that Singapore banks is still worth a buy for dividends. Next, okay, so next I will come into REITs. Okay, so why it is benefit to have REITs? Okay, so I have explained earlier on, okay, why interest rate cut REITs actually will benefit. So from here you can see that I put more in fact to REITs. Earlier on, I only have 10% on REITs, but over here you can see that now instead of 10%, I actually has 30% on REITs. I reduce my investment on bank. I actually focus more on REITs because there is a potential rate cut. So from here you can see that I actually invest into Capital Integrate Commercial, 10%, Maple Tree Logistic, 10%, Fraser Centrepoint Trust, 5%, and Keppel DC REITs. Okay, so this is actually a very new. Okay, so REITs is basically on a data center. Okay, so this is actually with a high potential of growth. So therefore, I decide to put 5%. Okay, so again, let me explain why it is justified. Okay, so basically when interest rate cut, okay, it actually has a direct benefit. Okay, all the REITs, majority of them actually has a direct benefit. Why? Okay, so lower rate or lower interest rate means cheaper debts. Okay, so basically when they actually buy, for example, building, doing some of the project, they actually take a loan. So when they take a loan, okay, which means that when the interest rate is actually reduced, which means lower rate, which means that they actually directly so-called benefit. Or if not, they can also choose to refinance, okay, or borrowing for the asterisk. Okay, basically they will boost their profit and your in dividends. Okay, so in short over here, you can see that majority of the REITs, okay, how they do business is they need a huge capital. So in order to generate the huge capital, they actually borrow from the bank, for example. And with lower interest rate, this is actually direct benefit. And then they also can choose to refinance whatever loan they have. And basically, this is why for REITs is actually a direct benefit. Relative yield. Okay, so as bank saving and bond rate fall, okay, so you can see that when interest rate cut, okay, the amount that you actually put into saving, they also will be reduced. Singapore bond also will reduce. So therefore, this makes Singapore REITs dividends become more attractive. Okay, we come into the Singapore REIT strength. Okay, so they are well managed with strong balance sheets and own resilient asset. Okay, for example, logistic data center that provide stable income even in a slower economics. So this is actually the REIT strength. So if although the economics actually so-called become bad, let's say, okay, so they have strong balance sheet, which means that they can outlast the so-called, let's say, the downtime. So this actually will provide us some stable income, okay, for a nice dividend also. Okay, so this is the important thing when we actually invest into REITs. We need to watch why. Okay, why Fed want to cut the interest rate. This is very important. So let's say if the interest rate cut is because of strong economy. Okay, so basically this is to do a soft loan lending. So this is actually great. Okay, so basically for REITs, they actually will benefit better. Okay, so if it's due to a sharp recession, okay, the tenant default could potentially hurt the REIT's profit. Okay, so basically this will so-called hurt only the REITs. Okay, so when interest rate cut, okay, let's say it's because of recession, then a lot of tenant probably will forfeit their rent, forfeit their whatever so-called fees that they're supposed to pay. This potentially will hurt the REIT's profit. However, if you look at current situation, okay, why I say that it's good is because current situation, you can see that the shares are all-time high. So which means that technically the economy should be still good. So basically the reason why Fed cut the interest rate is because inflation is not longer there. And honestly, okay, in US, they see a trend of unemployment. Okay, so but the economics is still considered fundamentally good for US. If not, not all the share can be all-time high. So this is actually the watch the why. So the bottom line, it is a justification for a strategized long-term investment in high-quality Singapore REITs, not a signal for a short-term speculate trade. Focus on REITs with strong finance and defensive property. Okay, so basically this is why I choose these four, okay, with a total of 20%. Next, okay, I come into industry. So this is how I relocate onto the industry. So ST Engineering, 10, Singapore Airline, 5, Keppel Corporation, 5. Okay, so basically this is how I allocate the fund. So operational performance over rate. Okay, so basically you can see over here, these three companies actually offer some form of performance. Okay, so they have not much impact when actually Fed cut the interest rate. Okay, so their investment case is driven by core business growth. Okay, for example, air travel demand for SIA, global defense aviation's contract for ST engineering. Okay, but they are not about interest rate. So therefore, a strong operation outlook outweigh the minor benefit of lower borrowing costs. Okay, so basically this is why I diversified my risk. So you can see that I actually has 10% on industry. Coming to the defensive and growth quantities, okay, so these are blue chip company with strong market position. ST Engineering's defense backlog provide resilient earning, while SIA restore profitability and network strength after it a direct play on the structure growing Asia travel plan. Okay, so I must admit that probably SIA didn't do so well during the COVID period, but now COVID is actually behind us. So all the so-called traveling actually happen fast and furious now. So this is why I decided to go 5% on Singapore Airline. Next will be on the attractive yield play. As interest rate fall, okay, their reliable dividends become more attractive to income investor seeking better returns than saving account or bonds, potentially driving share price appreciation. Okay, so this is what I have always explained. Once interest rate reduce, when we actually used to put our money into saving to earn the little interest rate, so now the interest rate further reduce. So therefore, we probably will seek another alternative higher yield to invest on. So therefore, this is actually a very good avenue. Okay, so these are what we know as a defensive stock. They are actually quite resilient against interest rate. So therefore, in short, here we actually invest for their strong business fundamentals and exposed to avionics defensive growth, not a trade on interest rate. A Fed cut is actually a minor tailwind, not the core reason. Okay, so basically this is how I diversify my risk. Okay, you can see that I also choose in terms of the industry. Next, on the utilities and infrastructure. Okay, so I only just select capital infrastructure. Okay, so justification again. Okay, so again, this is also a very defensive nature. Okay, so utility. Okay, so no one can live without utility. Okay, so therefore, utility actually provide essential service, for example, the power, water, and waste, with stable, regulated cash flow, making them a defensive anchor in an uncertainty economic climate that often companies rate cut. Okay, so when actually economy become uncertain, this actually will so-called infuse rate cut, and therefore we must always choose some defensive shares, for example, capital infrastructure. Okay, so this is actually for long-term growth driver. Okay, so they are actually central to Singapore and Asia multi-decade energy transition and decarbonize goal. For example, they have this hydrogen, renewable, carbon capture, all this actually is a good so-called revenue when actually Fed cut the interest rate. Okay, so when rate cut can lower the cost of funding, okay, so this massive capital intensive project. Okay, so next will be on the inflation hedge. Okay, so many infrastructure assets have revenue directly linked to inflation through contract, protecting real returns as rate fall and potential inflation persists. So in short, okay, let me just say something on the utilities and infrastructure. So they are actually they are actually considered defensive stability combined with structural growth themes. Can make them actually very attractive, okay, to invest. Okay, so we don't really need to just consider in terms of the interest rate cut. So this is actually also another defensive, okay, stock for dividends. Telecom. Okay, so I'm sad to say that I probably will give a miss on Telecom. Okay, so over here I will explain why. Okay, while the Telecom, okay, so primarily we have Singtel and StarHub. Okay, so in Singapore there are actually three big telco: Singtel, StarHub, and M1. And M1 is actually not listed anymore. Okay, so therefore, okay, for telecommunication is mainly Singtel and StarHub. Okay, so they have been tradition dividends darling in the Straits Times Index. Okay, the landscape has fundamentally changed. Okay, so things change. Why? Okay, so we are going to have, in terms of telecommunication, okay, it's actually a very stagnant growth. Okay, and then they have very intensive competition. Okay, so basically, this is what we know as a saturated market. Okay, because Singapore mobile penetration rate is more than 100%. There are no new customer to acquire. It is a pure market share game. Okay, so basically, all the so-called Singapore, all the market share, they are already all taken. So basically, this is how we share the market now. So therefore, this is one of the reasons why I decided not to invest into telecommunication. Coming to a price war, the entry of a fourth player, okay, TPG Telecom, okay, which is now Simba. Okay, so in fact, Simba potentially may buy over M1. This actually disrupt the whole market. Okay, to complete, the big three has to slash price for their mobile plan, direct eroding their profit margin, while the price war have cooled. Okay, but the competitiveness pressure still remain. Okay, so basically you can see that okay, everything, every business model they actually try to do, there will be a lot of competition. Okay, so therefore, this is also another reason why I give a miss to telecommunication. Next reason is because of the high capital expenditure and debt level. Okay, so 5G roll up. Okay, so 5G roll up currently is still rolling out phase in Singapore. Okay, so all the telco has not so-called fully has this 5G rollout. They still in a different phases of 5G rollout. Okay, so building a nationwide 5G network is very, very expensive. Okay, so this in fact require massive capital expenditure, which eat into their free cash flow that is used to pay dividend. Okay, so like I mentioned earlier on, 5G network is still deploying in Singapore actively, and these are all very so-called expensive, and this actually eat up into the money that is actually used to pay dividends. Increase debt to fund this capital expenditure. Telco have taken on more debts. Higher debts means higher interest rate. Okay, so like I told you that higher debt means higher interest rate, further reduce the cash available for shareholder. A company actually prioritize debt repayment is often a company that cannot grow its dividend. Okay, so I believe that most of the telecommunication they actually prioritize actually how to repay their debts. So therefore, when they actually repay their debts, they definitely has lesser to offer as a dividend. So these few reasons are the reason why I have decided to give telecommunication a miss. Last but not least, this is what we call this others. Okay, so we know that Sheng Siong is actually quite hot. Okay, because nowadays, okay, so for those that are not living in Singapore, let me just explain. Okay, so in Singapore, used to be dominated by NTUC. Okay, but now you can see that Sheng Siong actually get some momentum. So therefore, this is my move. Okay, I will actually buy 5% okay onto Sheng Siong stock for dividends. SGX is also a good buy. Okay, so why? Okay, currently you can see that most of the share are close to all-time high. So therefore, SGX actually indirectly benefit, or I should say that SGX actually directly benefit this. So therefore, I have decided to allocate 5% to Singapore stock, to SGX stock also. So with this, that's all I have for this video. But again, guys, I like to re-emphasize this. I am not suggesting you guys to invest onto so-called this stock okay, for dividends. But if you have done good homework, you have done your own research, and if you think that okay, so you plan to so-called invest into Singapore stock for dividend, then this video will be relevant. Okay, so basically this video show what I think will be the best when actually Fed cut the interest rate. So with this, that's all I have for you guys. Thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.